All right, well, thanks for joining us, Nico, for this interview, mainly on DeFi, but we'll talk about LiquidMeta quite a bit too as well. Nico is the COO and he's the co-founder of LiquidMeta. On their site, I sort of looked at it and took off a little quote that you guys have there just to try and start off with what you guys do. LiquidMeta says on their site that decentralized finance is the most exciting innovation in the financial world. However, DeFi is still widely misunderstood and underappreciated by the traditional finance and general investing public. So part of this interview, we want to help with that fact that DeFi is misunderstood, underappreciated to try and, help out with appreciating it more, understanding it more. And then I guess this is the key sentence that you guys have here is LiquidMeta is building the bridge between traditional finance and decentralized finance. So building the bridge between them. So in the interview, basically, we'll have 3 parts. I just want to talk about, Nico, your background, how you got into DeFi, sort of maybe why it matters to you more on a personal level because of your background. Then we'll talk, secondly, about DeFi in general, sort of what it is, why it matters, how it works. With a little bit of focus on stablecoins, because those are, especially with UST right now, it's a bit of interest because it's, in some chaos. And then thirdly, we'll finish just talking about LiquidMeta and what you guys are doing in the DeFi space. I'll just read a little bit of your background and then you can expand on it. This is again from the LiquidMeta website. I'll read it and then you can give us some more detail on it. So on the website, it tells us that Nico is an economist, master's in finance with 10 plus years of experience working in emerging markets in the blockchain and fintech industry. Nico is a partner at bidx.la, with one of the main crypto exchanges in Latin America. And then previously, Nico was director of fintech at Endeavor Global and VP of sales at dLocal. So maybe, you can just fill in some of the details in your bio, then you can even go back to sort of growing up in Latin America and how that shaped your view of traditional finance and why you entered the DeFi space.
Sure, and thank you, Nelson. Thank you for having me. It's a true pleasure to be here. So maybe to start from the beginning, and as you were saying, my background is in economics and finance, and I was born and raised in a very particular market like Argentina, particularly with Argentina is like an ongoing experiment on the economy. I was, before jumping into crypto or before meeting Bitcoin for the first time, I was working in traditional finance, right? Helping local companies access better financial services and products, find investors, and access the capital markets. And all of the sudden, the story goes that there was our former ex-president got re-elected. And one of the measures that was installed right away was the local population was not allowed to buy foreign currency anymore. It was illegal to buy US dollars or any other currency outside the local currency, the peso, right? And this was delivered in a context of high inflation, double-digit inflation that continued to rise. So all of the sudden, my job became quite boring because no one really wanted to invest in a market like Argentina. And I started to realize that how little permission, literally, we as individuals and we as a local market, we had to operate within the local regulation. And it was in that context that I learned about Bitcoin early on, and I got fascinated right away by 2 concepts. The first one was the concept of a non-governmental money, right? Money that wasn't issued by any government. And I've read about this in the Austrian books, out of the 70s. So in theory, I knew there were some ideas about the concept of private money, if you like, but this was coming out of nowhere. And then the fact that Bitcoin had a very limited issuance. There'll always only be 21 million Bitcoins ever created. And that really resonated me coming out of Argentina, where the local government was and continued to keep printing local fiat without any collaterals. And that pushes inflation and that taxes the whole population in many ways. So I was lucky enough to pay attention to Bitcoin, to start investing early on. Then the story with BitX is that I helped start it in a way. I introduced the founding partners. My dad ended up being the CEO for many years, and BitX really became the first formal crypto exchange out of Latin America. So I've been quite privileged to follow the story of BitX and Bitcoin, and then the launch
What
of
was the timeline on
Ethereum.
this? Like, when was this when the
This was
thing started?
2013.
Okay.
And maybe that also speaks about being able to navigate the ups and downs on the markets and understanding how volatile or how sensitive everything was to markets reactions or yes, the ups and downs. I mean, how early that was. I remember when I got into Bitcoin, uh, I thought I was so late to the party because it just went up like 40%. So it was crossing the $100 bar, and I felt quite foolish about it. And then well, you simply learn how to hold, and
Yeah. Yeah.
I think you learn how to have a long time horizon. That's what Bitcoin taught me early on. So, anyways, I was able to follow the industry development. I mean, my career then moved a little bit more into fintech, not so much into crypto directly. Fintech back then for me was the promise to deliver financial services to the unbanked. And again, the context here, Argentina, Latin America, emerging markets, I think that's important. Around 50% of the population don't access a bank account. And back then, it was quite difficult to purchase anything online if you didn't have a bank account. So I think fintech pushed a little bit the barrier of services to a new level of the population that didn't need a bank account, and they could purchase with some sort of like debit account services. But back to one of your initial points, I do think DeFi is the real disruption here to the financial industry, because it's really reshaping the way a financial service or product is being delivered to the population. Fintech, I think there's a lot of merit, but in a way, it's pretty much it's very similar to a banking service, but without a banking license. So there's so much you can do with that. Fintech, DeFi is redefining the way the service on itself is thought and delivered.
Can you maybe, so I recently started reading Alex Gladstein's Check Your Financial Privilege, which is just
Yeah.
fantastic. It's opened my eyes a lot, because I've I've lived in the U.S. my whole life. Things like banking, credit cards, loans. I mean, that's a given. That's, take it for granted. But can you sort of maybe, with the unbanked, and maybe just other things like corruption or high fees with middlemen, can you maybe give us a picture of what it's like to live in Argentina and sort of be unbanked, and just, what sort of hardship does that create that would be good for Westerners to understand? Just give us a picture of what that looks like to be sort of out of the financial system.
Yeah, I mean, the first image is not being able to transact online, right? Purchase stuff on the internet. And nowadays, the internet offers not only the best products and services, but also the best pricing, because it's easier to compare pricing. So navigating a website like Amazon to compare to your local retail store, that gives you a benefit. Now, if your only option is physical cash bills, that's where you're limited to buy goods and services in your surroundings, let's say. Then it's accessing more sophisticated financial services, like a loan, for example. If you're starting your own business, most likely you'll need a loan to get started. Now, without the financial track record, without access to a bank account where you could deposit in some collateral in some manner, it's impossible to access any loan whatsoever. And from there, you can push it to more sophisticated financial services. If you go all the way up to investing, the investment opportunities that you can find in the US, purchasing a stock from Apple, from Tesla, whatsoever, that's super easy to do here in the States. It's not that easy to do outside of the States. And that's where the financial offering becomes more and more limited to the local population. And then you have whatever the local government is allowing you to do. The story back again in Argentina, still is the case these days actually, is that you're not allowed to participate in global trade, right? So it's literally forbidden to send a wire internationally. And if it's not forbidden, the cost of doing so is just restrictive, right? Literally, if I send money to my family in Argentina using banking rails, let's say they receive 100 pesos. Now, if I send them using crypto rails, they will receive 200 pesos. So it's that the difference. It's double the rate. And those are the types of limitations that some economies are having these days. Yeah.
Can you expand on this? Is something that's really interested me in terms of getting, as much detail in terms of, so in your example of sending money back home, like, so you said 100 versus 200, but in terms of like how much were you sending, how much was maybe lost from foreign exchange, like a bad foreign exchange rate, and then like if and I know that percentages fluctuate, like even network fees will fluctuate, but in
Yeah.
general, so what percentage do you think is sort of, if you send $100, what percentage is getting lost with traditional rails versus what percentage is getting lost, if you were to use crypto?
Yeah. Yeah, remittances is the one industry to disrupt. Is the low hanging fruit in that sense, particularly for small transactions, for small payments, like let's say $100 transaction. You want to send $100 outside the US, and then you need to go through the SWIFT network, right? And that's where you have transaction fees that will erode your payment. Speaking about a $25 transaction, that's not crazy, and that speaks about 25% fee out of the payment if you're sending a micro payment. Now, and the example of Argentina, I believe this is just Argentina, but Argentina has an issue with the exchanges rates, right? So if you go through the banking rails and I send $100 to a bank account in Argentina, that bank account is officially converted right away into pesos at an official exchange rate that's quite fake, that's not available in the open market. And that's where you get the rate of 100 pesos per dollar. Okay. Now, if you send crypto or if you send cash and you go to the open market to change that cash or that crypto to local currency, you get double the rate. You get 200 pesos per
Ah, okay.
dollar.
So you're talking about that was the exchange rate that you were mentioning.
Yes.
Wow.
So
So
there are
it's
three
double.
things here. You have fees. You have the transaction fees. You have the exchange rate, and then you have timing, right? Typically, sending an international wire can take easily between 3 and 5 business days. So that's also a long time to consider. Now, shifting into crypto, you can send all these transactions practically for free within seconds or minutes, and without asking any permission to anyone.
What in your case, like with family, what are you using stablecoins, sending Bitcoin? What in particular?
Yeah, stablecoins over the last couple of years, they've really not nominated the unit of account within crypto. So everything is pretty much trading against a stablecoin. So if you want to send a value, typically you will send a stablecoin simply because it's stable, it's reliable, and then we can talk a little bit about the different types of stablecoins that are out there.
Yeah. We'll get
But yeah,
to that.
and there are some stablecoins that are more popular in some markets. And for example, USDC is highly popular in North America, in the US, and maybe in Asia and also in Latin America, USDT is more popular. So if you want to send money to Argentina, I would send USDT because I know it's more liquid in the local market. It's easier to trade to local currency.
Just to get another sort of just idea of how it works. So you send it to your family, and then are they able to use the crypto as a medium exchange, or did they always sort of have to convert to cash out to fiat, or how do they in that particular example end up using the crypto that you send?
Yeah, for daily purchases on utilities or services or goods, it's very nascent, but recently over the last year, they've been popping up different services, crypto fintech services that they allow you to hold funds on crypto, on stable coins or others, and use those funds using a debit card or a credit card, a debit card for the most part. So that's the type of innovation that's reaching the market very recently. But now you can actually hold like a crypto wallet with crypto assets on it, and then use a card to simply debit funds from there. So you don't need to wouldn't even need to convert it into the local currency before using those funds.
And with that debit, obviously because I saw recently with Crypto.com partnered with Visa. I know
Yes,
Coinbase has a card. So with that card, I mean, they can make purchases at the grocery store or a coffee shop. It's
exactly. I
right.
mean, they're all Visas or Mastercards, and what's changing now that on the back end, what's holding the account, there's a crypto wallet.
Right. Yeah, I recently signed up with Coinbase because I saw that they're doing that. The
Exactly.
Crypto.com one seems really complicated, so I didn't. You have to hold an amount of collateral or something like that. Anyway, yeah. So let's shift into DeFi a bit. I first heard about DeFi from Kevin O'Leary, Mr. Wonderful on Shark Tank, who's now
Yes.
a pretty big, advocate. He's in the space quite a bit with WonderFi in Canada, and
Wonderfy.
I
Yes.
think does he still have connections with Hut 8 mining? I know he did in the past, but anyway, yeah, Kevin O'Leary, Mr. Wonderful, he's big on this, and that's how I first heard about stablecoins. He was talking about foreign exchange basically, and wanting to put out of business, the middlemen who do the foreign exchange because it was just taking up so much. Then a few weeks ago, so this is
Yeah.
just me personally hearing about it. I met with the CEO of IntelliBridge, John Eagleton, and he introduced me to the Terra stablecoin using Anchor protocol. They started an app called Cash with a K, where you can stake them for 10%, and then with Anchor protocol, I was looking 20%, and I was thinking, wow, this is like, how are they able to do 10,
Yeah.
20%? This of course now, UST has crashed down to when I looked this morning, 62 cents. Way down from what it's supposed to be. So that's sort of how I
Yeah.
first heard about it. But yeah, so if you can sort of just start off, I'll have a lot of more detailed questions, but just start off with sort of a definition, and then maybe three or four or five, however many you think is best to start with, sort of sectors within DeFi. But yeah, just a really general, the best that you have, general definition
Yeah.
with a couple sectors within it.
Yeah, because DeFi on its own, it's growing as a nation category, offering more and more financial services and financial structures in a way. Stable coins on its own, there are different types of stable coins. There are some that are more open about the collateral that they're holding. I like to always refer to USDC as the company with the biggest level of transparency, and they show how much either direct US dollars they're holding in their bank accounts or um, um, cash equivalents they're holding in order to issue or mint a new stablecoin. Similarly, others like USDT, maybe not as transparent as USDC, but with a similar model. Maybe USDT is also a little bit more risky since it's holding also crypto assets as collateral. And then you move through the different alternatives. You find some models that are over collateralized for the most part, models like DAI and MakerDAO, where you as a user, you would need to deposit the collateral in the first place. You deposit ETH, for example, and for the amount of ETH that you deposited, then the system allows you to mint a certain amount of DAI, DAI being the stable coin always worth $1. Now, if you want to recover your collateral, you need to return basically the DAI that you took as a loan. This is a loan. And and then the level of creativity didn't stop there, and new models went to market, including UST, that was pretty aggressive in their initial go-to-market strategy, and the balance between a new blockchain layer one like Terra and its token Luna, and the relationship with the stablecoin UST. And and then you have the fact that they launched with a platform like Anchor Finance offering fixed returns, a fixed yield of 19.5% to whoever deposits UST on the platform. So that's really attractive to anyone, obviously, and that got a lot of attention. UST Anchor alone was holding almost $20 billion last week on the platform, 20 billion, and paying 19% to $20 billion. So that's creating a lot of new fake wealth in a way. We can elaborate whatever on why the system collapsed and why the stablecoin is no longer stable. It lost the peg, and Luna lost almost all the market cap. But the reality is that different financial services are being offered within a DeFi landscape. I believe the first one was lending, as what I explained with MakerDAO. You can take a loan by simply depositing collateral and immediately using that loan for something else, and that became early on very attractive to any long-term crypto holder. So imagine you hold ETH and you don't want to sell ETH, but you want to use your capital for something else. So a system like MakerDAO allowed you to access a stablecoin while holding your ETH as the collateral. So you could deposit your ETH, access stablecoin, maybe you wanted to launch a business with that or take a vacation, whatever. Eventually, once you pay your debt back, you can withdraw your ETH back again. So you don't lose the exposure to the appreciation on the ETH, while you can use the stablecoins for daily or purchases or whatever. For that model, I do like to emphasize the source of yield in DeFi. That's also very a topic that gives room to a lot of confusion. And then we can address the 19%, and then we can address some crazy yields that are here in DeFi. Now, on the model of Maker, on most of the lending protocols, you basically have an interest rate here. So I think this is the easiest one to understand, because this is one that's pretty much comparable with traditional finance. Whoever is borrowing money is paying an interest rate, and whoever is depositing money, they are getting paid that interest rate. There's a spread in between both yields, and that's basically the income of the platform, right? So that's pretty straightforward, and there's nothing crazy. Those yields are pretty average, a little bit more attractive than traditional finance, but they are within range. Now, the second service that came through DeFi is the service to be able to exchange one token for the other, right? You mentioned, Nelson, you opened an account at Coinbase. So the first business model of Coinbase is allowing you to trade crypto. So you show up and you can purchase Bitcoin, you can purchase ETH, and you can sell them whatever. And when you do so, you're basically paying a trading fee. That trading fee represents the revenues of a company like Coinbase. With that, they can pay their rent, salaries, operating expenses, etc. Now, that service of being able to trade tokens for one another, that was automated through an innovation that's named AMM, the Automatic Market Makers. That's the name of a smart contract. A smart contract in the end is just software. It's a piece of software on the cloud. Now, the way this works on DeFi is not necessarily a peer-to-peer transaction anymore. It's just having an individual like you interacting with a liquidity pool, right? A pool that holds liquidity, and that pool it's run by a smart contract, again, just software. And that software will understand that if you send token 1 to the pool, they will give you back token 2 at a fair market price. So that helps if you're trading tokens. So maybe you show up with a stablecoin and you want to purchase ETH, and so if you do it, so you're interacting with a liquidity pool that's holding both the stablecoin and ETH, and you're simply paying upfront stablecoin, and the pool sends to your wallet the ETH at the fair market price. So it's exactly the same service that you can find on Coinbase, but with some key differences. First is that there's still a trading fee, but the trading fee is much cheaper. So it's more efficient to trade with a decentralized application versus a centralized exchange. Second is that the offerings, the number of tokens that you can find on DeFi platforms is way more robust. And the story goes here that maybe a couple of years ago, if Nelson, you wanted to launch your own token, the Nelson token, let's call it, and you wanted to access the liquidity of crypto, you wanted your users to be able to trade the Nelson token, you had to have your token listed on a platform, on a company like Coinbase, like Binance, FTX, whatever. And there are at least 5 companies that are really dominating the liquidity of the market here. So long story short, the thing is that it was quite restrictive for any individual like you, Nelson, to list your token on those platforms because it was quite expensive and restrictive, right? So you had to pay fees in the form of millions in order to be listed on those platforms. Now here comes DeFi and these smart contracts that are simply enabling anyone. Naturally, so you do need to comply with a criteria of quality and security of the token, but in a way, anyone can create a token, the Nelson token. Anyone can create a liquidity pool on these decentralized exchanges, and once the liquidity pool is created, then I can come in and trade that Nelson token at the market price. So the things that I can buy or sell on DeFi are way more interesting than the things that I can buy or sell on those centralized exchanges. Now, let me introduce here, and feel free to stop me if you have questions, but there's a key concept here that's the fact of the need for liquidity. And this is the key of what we do at LiquidMeta. Now, DeFi is basically the combination of 2 things. You need liquidity on the one end, and you need those smart contracts that are simply automating transactions. Now, you need liquidity because you're delivering a financial service. And without the liquidity, the financial experience, the financial service will be quite poor. The product will be delivered at a high slippage, maybe too slow. The experience will be quite poor overall. So there needs to be an incentive for liquidity providers to provide liquidity to a particular project, right? So all these liquidity pools that I mentioned, the one holding the Nelson token or the one holding ETH or the millions of liquidity pools that are there, they need liquidity in order to provide a good service to the users. Now, back to the example, when I'm trading Nelson token on a decentralized exchange, I'm also paying a trading fee. And I mentioned that's cheaper than the fee that Coinbase would charge me, but there's still a fee. Now that fee, there's no operational expenses behind that project. There's no salaries, rent, there's almost anything to maintain. So that fee is distributed out among liquidity providers of that liquidity pool. So if you were to be providing liquidity to a pool with a lot of activity, with high level frequency of transactions, that's where the liquidity providers are earning very generous yields. Yield is the way of calling it, but the yield here, what I'm trying to say, is not coming out of an interest rate. No one is borrowing or lending money. The yield is coming out of transaction fees that DeFi users are paying in order to interact with these liquidity pools. Maybe let me stop here and let that.
Right. Because the liquidity pools, that's a big part of LiquidMeta. But so how does that relate to, let's say, staking? Like, I'm staking Ethereum for the upcoming, change to 2.0. So how does that sort of, and then, can anybody join a liquidity pool, or do you have to have a substantial amount of, or maybe I don't exactly know the relationship between staking and liquidity, but maybe you can explain that part.
Yeah, that's a good point. Let me address that. Proof of stake is the evolution of proof of work, right? It all started with proof of work, with Bitcoin, where you're simply, you need to purchase equipment, machines, you need to connect them to electricity, power, and then the computer starts validating the transactions, and the reward that you're earning is basically the new Bitcoins that are issued by the network and the transaction fees that are paid by Bitcoin users. And that's the model of proof of work mining. Now the model evolved into proof of stake, where electricity is no longer needed, and you're basically locking your stake of liquidity in order to collaborate with the pool of those tokens that are going to be issued. Now, all these networks, they have an issuance rate. So Ethereum 2.0 on all the other layer 1 blockchains, they all issue new tokens every time. And those tokens are distributed out on a pro rata share to those that are staking their assets in order to validate those transactions as well. So that's proof of stake. And so the yield that you're earning on proof of stake is not an interest, is not a transaction fees. It's basically the issuance of the new tokens that are created by the network.
So then what's the value? I understand if you're helping to create liquidity, but what's the value that, my Ethereum is creating by staking it?
Has to do with the security, and I'm not the expert here, but you're basically blocking a larger amount of ETH in order to keep the network safe. And you get compensated by receiving your fair share of the new ETH that are issued to the network.
Okay. Yeah. So then that versus
but
the liquidity
the example,
pool.
the liquidity pool. So they replicate. They are inspired by the same fact that you need to stake your liquidity, and then you're compensated by doing so. But it's very different. So back to the example is anyone can do this, by the way. So let me put that out of the way. You can log into any decentralized application, a decentralized exchange like Uniswap or SushiSwap, or there are hundreds out there that you can search. you can go to the options of farming or liquidity pools, and you see the pools that are open out there, and you can monitor at least a few things. You should monitor the total value locked. So that speaks about the amount of liquidity that's already locked inside that pool that is staking, and the current yield. That yield is highly volatile. It moves up and down, and that yield will speak about, for the mature project, it will speak about the trading fees that are paid out to liquidity providers. It's a little bit complicated to stake your funds, but nothing that you cannot find by your own, with lots of materials on YouTube and the internet. Now, it's not the same as trading on Coinbase, maybe to compare it. That's one of the reasons why LiquidMeta is building a bridge, and then we can talk a little bit about that in order to make things more safe and simpler. But in the end, you can decide to provide liquidity to any of these pools, and by doing so, you start earning those yields right away. Now, let me clarify that for the most part, those liquidity providers, they earn two types of yields. The first one is the trading fees that I described, and the second one is named reward tokens, let's say. Now, in this DeFi world, everything is run by a token, right? So these platforms, like SushiSwap, for example, SushiSwap has a governance token that's called Sushi. So there's the Sushi tokens. Maybe for simplicity, you can make a correlation with shares. If you want to buy a participation in SushiSwap, you can simply buy a Sushi token. Now, SushiSwap as such is a DAO, a decentralized autonomous organization. So those tokens, they are not held by any individual that's able to direct the company into one way or the other. Those tokens are issued and distributed among the participants of SushiSwap. So, especially early on, those Sushi tokens are distributed out also to the liquidity providers. So, on day one, imagine there's no liquidity in the pools, there's no activity trading. Day one, the platform goes to market. Say there's 5 liquidity pools, and there's a rule, very transparent, that says we are going to allocate X amount of Sushi tokens to each liquidity pool, and those will be paid out every minute to liquidity providers. Now, if you are the first liquidity provider, you're capturing 100% of those reward tokens that are being paid out. And then as more liquidity providers join the pool, those tokens are distributed out among more liquidity providers. And that's where that initial yield goes down, right, until you find some equilibrium. Now, over time, that platform becomes more popular, so more users are interacting with that platform, and when that happens, more fees are being paid out, and that's where the yield gets compensated with transaction fees. Times like this, actually, this morning I was checking our liquidity pools, and because it's a highly volatile week, because everything that's going on with Luna and with the overall markets, one of the pools where we deploy liquidity was typically paying a yield of 30%. Maybe went down to 20, maybe up to 50, but it varied around 30%. And this morning was over 400%, right? Okay. The yield that was. And that's because there's so much activity when it comes to transacting with pools like that the transaction fees are adding up to the vast majority of the
And just to clarify, this is not like, 30% of what you put up as for the pool, right? This is 30% of what's being paid out every minute, right, to the providers.
So it speaks about 30% of what you hold inside the liquidity pool, but it's on an annual basis, and that yield is highly volatile. So it was 400% today. Most likely tomorrow it will go back to the average 30%. That was the usual equilibrium.
Sorry. Okay. Yeah. So I was
But
I
what I'm
was
saying,
mixing up the so the staking is the issuance of new tokens, and you're getting a portion of that versus the
that's
liquidity
fixed.
pools. You are getting a percentage of what you put up, right? So if you put up more, obviously you're getting more versus, but then it fluctuates.
Yes, but the key component is the transactions.
Oh, the volume,
The
right,
more
of the coin.
adoption, the volume of the
Right,
transaction,
right, right.
exactly. So so DeFi grows in two ways. It grows in TVL, total value locked, and this speaks about the liquidity providers, more people staking on DeFi, and then it grows in volumes. As more people interact with DeFi protocols, more transactions fees are being paid out, and the yields also go up. So I've been in DeFi since the total TVL worldwide was below $1 billion. At the peak of the end of last year, it was almost $300 billion. And the reason why the yields didn't really collapse that bad, even though the liquidity went up more than 300x in just a year and a half, is because the level of transactions also is growing at the same level of the liquidity that's coming.
So, in terms of liquid meta, I know you guys are providing liquidity with what are the specific, let's say, coins or
Yes.
projects that you're, and then why did you choose those ones?
Yes, good question. So what we do at LiquidMeta is we're building the bridge between traditional finance and decentralized finance. And the very first thing that we realize is that being able to participate in DeFi is a little bit complicated and very much risky. It's complicated because you need to deal with multiple steps. We like to say that crypto and DeFi, are they probably hold the best engineers in the world these days, but definitely not the best designers in the world these days. So the user experience is quite poor. And for me to take a position in a liquidity pool, you need to take at least 10 different steps, right? So you need to know what you're doing. It's not as simple as connecting into Coinbase and buying a token or selling a token. And then it's risky because it's open source. I mean, in a way, anyone can launch a new decentralized application or go to market with a proposal like UST, for example. And there are different risk parameters that you need to assess. You need to understand the business model behind it, and you need to understand the security level behind it. So pretty much what we do at LiquidMeta is diligence on these platforms and these models, and then we have our own way of scoring the level of risk that each opportunity brings, and then deciding which projects to fund or not, right? So what we do at LiquidMeta is we are building a staking platform that's going to make things very, very simple and safe for users to stake and start getting the same yield that LiquidMeta is getting. So we will be opening the doors of our products and strategy that we are currently testing and deploying. And then we like to eat what we say. And so we have our own balance sheet that's fully deployed into DeFi these days in a very diverse manner. We have positions in over 20 liquidity pools and over 7 different blockchains, earning a yield by the second, day in and day out. That yield is what we use to pay our operational expenses. That's the yield where we find the revenues to invest in our platform, and that's the yield it's driving the growth of LiquidMeta. And that's how we are testing the market, understanding the strategies that we are deploying, and we're using all those lessons learned in order to build our own platform. Now, the strategy that LiquidMeta brings to market, and here's where everybody's free to build their own strategy in a way. Just to summarize it, we like to name it a very stable strategy, right? So we like to think we have a product where we can capture the revenues and the value that's created out of DeFi without the exposure to the volatility that crypto has and that DeFi magnifies in a way. Our proposal is not to get you exposure to DeFi tokens. Our proposal is to get you exposure to the value that's created out of DeFi. The same way Coinbase is generating revenue by enabling users to trade, DeFi is doing the same, and our platform is allowing you to capture that value, those revenues that are created in DeFi. So it's very diverse, it's very stable, and we do this with technology. We are able, it's stable, but it's not only stable coins. So maybe that's a good clarification. We have our own way of removing the volatility out of the equation, hedging out any potential volatility or fluctuation, and simply focusing on a net yield that's simply more than enough to cover our budget and enabling us to grow on top of that. So we've been happy to report that we've been profitable since day one. We've been growing forever since, and these days, I mean, we are proud about the strategy. Most of or all of the current year, since January, actually, the markets have been going sideways. So we are happy to report that our balance sheet is not only strong, but it's growing by the day.
Yeah, so if we can go back to sort of talking about stable coins and getting into the Terra, issue. So maybe you can talk about the top three. Well, unless Terra lost its top three, but the top three right now, are USDT Tether, USDC with, well, let's see, I took the numbers this morning with Tether has 83 billion, and then USDC 48.4 billion, and then Terra is down to 9 billion, and market cap fell out of the top 10. So maybe you can talk about each one and sort of a little bit of the history and the use. You were saying earlier that like when you send money back to family in Argentina, you use Tether because of its liquidity, whereas I think your CEO, when we met a couple weeks ago, you were saying that you guys pay your employees in USDC, or at least some of the foreign ones, right? Employees, and then of course Terra, and what happened there. But maybe you can just talk about each of the top three and use cases.
Yes, of course. What my partner John mentioned is that USDC is our favorite for a few reasons. First is a model we like better in terms of transparency, acknowledging the collateral behind the stablecoin. It's a US-based company that's working close with the US regulators. And what they try to bring is this transparency on what's behind the stablecoin. So showing access to bank accounts and showing fiat as collateral for the stablecoin. Also, USDC is the most popular in DeFi, so that's also another reason why we use it a lot. It's for the most part is the trading pair of most of the tokens that are trading on DeFi platforms. So you're selling ETH for USDC or the opposite. So we do like it a lot. USDT is the biggest in the world, and it's the first one out there. It's run by Terra, supported by Bitfinex. They're not as transparent in terms of what they're holding as collateral. They don't need to be as transparent anyway, and they're open about saying that they don't hold one-to-one in terms of fiat to stablecoin. They also hold crypto assets as collateral, so there's some volatility on their collateral, but it's the biggest and the most accepted in both Asia and Latin America. And that's why the example of if you're sending money abroad, make sure that you know what type of stablecoin works for them, even though that then you can easily trade one stablecoin for the other. That's a highly liquid market anyway. Back to the example, there are lots of liquidity pools holding USDC and USDT, and those liquidity pools help for those that they simply have one stablecoin, they want to swap it for the other. Now, UST is a very different model. It's an algorithmic stablecoin that was not supposed to be collateralized, and that was not the case. Its mission is to become the first, really. Let me quote this because there's a clear team behind the project. But their mission is to build the first decentralized stablecoin in the world, right? And the way it works is that it's part of the Terra blockchain that has their layer 1 token, Luna. And the way it works is that the rule says that you can always redeem $1 for $1 worth of Luna, right? And that's how, until this week, USD was holding its peg, because there's a clear seniorage opportunity for market makers. So the minute the peg moves a few cents above $1 or below $1, someone can arbitrage that opportunity by redeeming the exact amount in Luna and going back to the market. And that's how the market used to keep the peg quite stable, right? Now, on top of that, in the way I think about anchor finance and that yield is subsidized, right? It's not sustainable in the long run. I like to think that yield is the cost of acquiring new clients for Luna and for USD. They are simply, and this is a little bit of the transition that I see between Web 2 and Web 3. Maybe the Web 2 model to acquire clients is to put ads and then go through the conversion of the funnel, and eventually those users, they come to the platform. But the long story short is that every company is spending money to capture users. That's called marketing and CAC, basically. Now in Web 3, everything goes directly to the user. So in this case, it couldn't be more literal. You're basically getting paid to participate in the project. So if you hold you buy USD, you stake your USD, you get paid 20% right away. 20% on an annual basis. But that's the rules. And what happened, my opinion, since early January, when the whole crypto market cap started to fall apart and maybe going down in values, that's where two things started to happen. The volatility in the overall crypto market started to transition out of volatile coins and into stable coins. And that happened across the board, from Bitcoin to Ethereum to Luna. So at some point, Luna started losing market cap, and USD had a quite compelling value proposition. If you were to be deciding which stablecoin to hold, and you had, like, let's put the risk, the safer stablecoins like USDC or USD, and then you have this other stablecoin like USD that came with the promise of a 20% yield in a context where earning the yield is quite difficult. Well, long story short, Luna USD market cap reached $20 billion in just a few months. So it really grew a little bit too fast, in my opinion. And at some point, the market cap of USD became very close to the market cap of Luna. And that's risky, because remember that Luna is supposed to be the one instrument where you can always redeem the fair stablecoin, the fair peg, the fair dollar value for those USD. Now, if USD were to be bigger than Luna in market cap, at some point there's not enough Luna to cash out everybody that wanted to cash out of USD. There were also issues with the yield, right?
So the best situation, right, is for Luna or the token of Terra to be, worth quite a bit more than, or the market cap to be quite a bit more than USD, yes, so that it's worth, when you exchange it out, you're sort of already making a profit.
Exactly. And that was the case until February. So for a long time that was the case, and it wasn't that risky. It's fine. In worst case scenario, I redeem it for $1 worth of Luna. Luna is highly liquid and you can trade it everywhere, and that's how you get out. Now, because of the market direction in one end, so Luna goes down with all the volatile tokens, all the stablecoins started to go up, because they're capturing all the volumes that's coming out of volatiles. And then you have the issue with the yield, right? The yield has been an issue for a while. It's been addressed by the foundation behind the project. In February, they decided to stop paying a fixed yield. So it's no longer 19.5, and they said that they would reduce, if needed, 1.5% per month until the yield reaches their sustainable rate. So it was, I think last week the yield was 18%, no longer 19.5%. But the volume got so big, I mean, we're paying 18% to $20 billion, that there's this fund called the Yield Reserve Fund was simply about to disappear. So they were doing fundraising for the fund, and they were adding capital to the fund so they could keep sustaining the yield. But that capital was floating out of the Yield Reserve Fund pretty fast. So it was clear that at the current level, there wasn't enough reserves on the fund to pay that yield for no more than 20 more days. That was the situation last week. So that was pretty close to something. Either Anchor would default or a new fundraising would be announced, but something was about to happen with Anchor. And over the weekend, there were some whales that withdraw significant amount of liquidity out of Anchor and out of UST, and that shaked the peg for a little bit. Then the foundation stepped in and added more liquidity into the stablecoin. And I think Monday, a new kind of attack or withdrawal happened, and then it was a systemic effect. Everybody had their eyes on the stablecoin at that point. So it was pretty clear that the minute a bank run started, it will be very hard and expensive to stop. And that's pretty much where we are nowadays.
I can't remember where I read that maybe they were putting up, because Bitcoin has gone down a lot in the last week or so. Did they end up putting up some Bitcoin to try and shore that up? And maybe that's
Yes.
why Bitcoin also had its own drop because of that.
Yes. That's also part of the recent news, and the decision that I mentioned in February to reduce the yield on a monthly basis also came with the decision to open a new collateral pool in Bitcoin. So that pool held $1.4 billion in Bitcoin, and the mission was to sustain the peg of UST if anything happened. And at some point this week, they used that pool in order to add liquidity to the stablecoin.
They sold
yeah.
whatever amount.
So
of
it was a
Bitcoin.
negative effect
Okay.
on the whole situation. Yeah.
So what do you think is the future of UST in terms of stabilizing it, and is it something to? I mean, I don't know if you guys are in UST, but what do you think is the future? How do they get back to 1-to-1?
Yeah, so no, I'm happy to report LiquidMeta is not exposed to UST. We didn't suffer the pegging of the project. As I said, we run diligence on the platforms and the tokens on a frequent basis, and over the last couple of months, it became too risky. We had UST in the past, but over the past few months, we've been reducing our exposure, and we were completely out of UST by this week.
So that's one of the value propositions that you guys would provide
Yes,
for consumers, is that you're watching, and you kind of, like you were saying with the market cap, you already saw the danger signs way before
absolutely,
others.
and that's why my friends they've been doing trading crypto for many years. They don't do DeFi because it's risky, and so you have the platform risk. Platform can be hacked. Then you have the business model risk, like in this case. And then you have the security risk. I mean, dealing with DeFi is dealing with your own private keys all along the way. So if your computer gets hacked, or if your password gets lost or whatever, you lost it all at once. So it's a very different experience than dealing with a corporation like Coinbase, that they serve a service by holding your assets and delivering a simple service. That's that. I mean, you nailed it. We believe DeFi needs a little bit of hand holding. So everything that we're doing is in order to simplify the experience of connecting to DeFi, to deploying liquidity into DeFi, and narrowing DeFi to those options that we believe are safe. Yeah.
Uh, in light of what happened, I did want to. We'll just have a few more questions because our time is basically up. But in terms of regulation of DeFi, we had some. I can't remember some congressmen talking about, let's say, auditing, USDC to know exactly how much they hold.
Yeah.
That'd be one example. But what sort of regulation do you think needs to happen in DeFi? And then on the other side of that, what sort of regulation would, scare you or would be bad for DeFi? So yeah, just the regulation of DeFi. What do you think needs to
Yeah.
happen and what would be bad or would scare you?
Yeah. I think the SEC and the regulatory bodies they have a first problem that's understanding the level of innovation that's happening in the world, and this is beyond crypto. I mean, currently, I mean, if you wanted to invest in, let's say, a crypto company, and you need to wait for a crypto company to go public, let's say Coinbase or Robinhood, whatever, and they are going public so late, you're basically missing all the upside as a retail investor, and you're simply not being able to offer that innovation to the average investor because you're protecting them. I mean, Coinbase is down 80% since the IPO, and that's the way of protecting the investor by waiting until they become like this $50 billion company that are IPOing. So I think that's there. And because the next question for the SEC is to determine what's a security and what's not. And I do acknowledge that there are a lot of tokens out there that they should be labeled as securities, but I do worry that if labeling by securities mean that no one is able to invest in them, in the same way that's very difficult to invest in private companies, unless you're an accredited investor, etc., etc. So I believe there's an equilibrium there that needs to meet certain standard. I do welcome regulation, but I do worry that the level of innovation is happening too fast, and the regulators are simply elevating the bar of what's not possible to do in this world. Now, the clear regulation that everybody will welcome is around security and fraud, because there are a lot of scams out there that are simply scamming people, and that doesn't help. And probably the example of UST is a good one. Probably some regulation needs to jump in before people get hurt. The project got too big at some point, and now, yeah, it's just a shame the way this is ending. Other than that, yeah, I mean, we're still waiting. I mean, Bitcoin has been out for more than 10 years now. Companies are just starting to feel comfortable by holding Bitcoin on their balance sheet, and they took so long exactly because regulation was not able to keep up by saying that Bitcoin is not a security whatsoever. My worry is two things: is that they over-regulate and they kill the opportunity, or they wait too long to regulate, so the real money is not able to enter the market until things are more clear. Our role, LiquidMeta, is a public company, so we like to think that we are opening doors to regulators to look into what we're doing and understand how DeFi works. We are the most transparent company that you can think in terms of showing what we do. Everything that we do is recorded on a public blockchain, and our auditor has access to the hundreds or thousands of transactions that we execute every day. So you can monitor exactly where the money is going. I don't think any traditional finance company is operating with the level of transparency that we bring. And so I am optimistic about finding a way of getting the regulators comfortable with what's going on in this space, and hoping for the best, of course.
Yeah, I guess we'll finish with sort of LiquidMeta, and maybe you can just, I know we've already talked about a lot of these things sort of separately, but just to sort of recap it all into one space, what are, the top two or three things? I know providing liquidity, and then I think, do you guys have a consumer-facing app also coming out soon? But just
Not yet.
so, what are the
Not
top,
yet.
let's say, two or three things that LiquidMeta is doing in DeFi, just to sort of, recap and have it all in one place?
Yeah, one of our investors framed it and in a way that I really like it, and it's such that we bring sense into a world that makes little sense, makes no sense. So we are able to participate and capture revenues in a proper manner without exposure to the ups and downs of these terrible cycles. I mean, what we bring to market is not a vehicle to embrace volatility. It's exactly the opposite. It's a vehicle that will remain steady for the most part, and on top of that is capturing revenues created out of DeFi. We are building a staking platform with a consumer face application, but that will be ready towards the end of this year. Currently, it's only making revenues with our own balance sheet, and the product is making progress, but we are using it internally for now until we are sure that it's safe and ready to be offered to the public. Yeah. That's another big difference with DeFi companies. Some go to market too early without enough testing, and that's how you get hacked, and that's how you might lose your funds. Yeah.
So if I could sort of finish in trying to understand, why somebody might want to, invest directly into LiquidMeta. You guys trade on the Neo exchange. Some people invest in MicroStrategy because they hold, I think 70% of their balance sheet is Bitcoin. So they
Bitcoin.
do that
Yeah.
knowing that, yeah, it's gonna sort of track with Bitcoin. It goes up and then it goes down, but you're fine with it going down because that's just Bitcoin going down. So you guys are, is it sort of similar, but obviously you're not pegging it to Bitcoin, but are you trying to sort of
No.
provide stability in the investments and also appreciation, obviously, from the yields? But is there a way to sort of compare it to how somebody might want to buy MicroStrategy to try and
Yeah,
follow?
the only comparison would be that we both have allocations in crypto, but the strategy is completely different. Our balance sheet is stable, and we create revenues as any technology company creates revenue, right? So we are building a platform that is allowing funds to be staked, and we're capturing revenues by doing so. We're doing this with funds that are on our balance sheet. Whenever the platform open, that's where funds will come in from outside of our balance sheet, and that's a new revenue line for LiquidMeta. For the time being, is getting exposure to the growth of DeFi, but in a very reasonable manner, without the ups and downs of prices. We believe prices are a short-term fluctuation. We believe the value of DeFi is happening behind the scenes, and our company is capturing it.
All right. Well, thank you so much for doing the interview and just introducing DeFi Liquid Meta to us. Be following you guys closely, and yeah, thanks for your time.
Thank you, Nelson. It's been a pleasure. This was fun.
Yeah, great. All right. Bye bye.